Anna, thank you for joining us on Capital and Power. Got to ask you real quick, the volatility out there because of the conflict with Iran. How are you responding to questions from your clients about this?
Whenever there's a geopolitical conflict and certainly a hot war like this, markets are going to react, but it's actually a knee-jerk reaction. Markets tend to sell off when there's a lot of fear and then discuss the details later. So usually the conversation is really around holding on tight, ignoring the noise, and making sure that they remember their goals and the time horizon. And if their portfolios are invested according to their time horizon, they really don't have anything to worry about.
As we see pressure to the downside, are you looking for a moment of capitulation? And if so, what would that look like to the rest of us?
So far the markets have been in a certain pattern, which is upon the futures are in the red, and upon open, there's a steep sell-off. And then during the day, investors come in very, very slowly. We saw that yesterday, and we're seeing that today. So to me, from a short-term time horizon perspective, it doesn't seem that people are running away. Having said that, there is no safe place to hide right now, not even in bonds. Treasury yields are going up. Even gold is down. The only place that has been safe is in oil futures and a U.S. dollar. Those two things are up. So if this continues, if the selling pressure could actually continue, I'm not expecting there to be a huge sell-off because, frankly, I think what's being priced in right now is a longer-term conflict. Yesterday, we thought, okay, maybe this will be like Venezuela and it'll be short and swift. Today, the matter is a little bit different. Something else would have to happen in order for the sell-off to continue.
Why is the dollar strengthening? Wouldn't it be the opposite in a situation like this?
The U.S. assets are usually seen as a safe haven. The only thing that doesn't really make any sense from a traditional perspective is U.S. Treasuries. The yields are going up instead of down. There are different reasons for that, including inflation prospects, of course. But people are coming into the U.S. dollar because the U.S. right now is in the position of strength. Earlier this year, as well as all of last year, we saw investors going out of U.S. and going to international assets. With this conflict, because the U.S. has control of the situation, or at least that's what the market believes, I think the investors are actually coming into U.S. dollar as a safe haven.
What do you believe? Never fight the market, but you used to manage almost $75 billion. What are your thoughts? Because you would know better than a lot of us.
There's a saying not to bet against the U.S. markets, and I think that's still the case. I know that because of certain, policies that have been put out by the White House, there's been a lot of fleeing of the U.S. markets in favor of Asian markets and European markets. And there's a lot to be excited about those markets if you're an investor and you have a diversified portfolio. But the truth is that a lot of AI innovation is being led by U.S. companies. So ultimately, if investors outside the U.S. or inside the U.S. too want to take a part of the AI development, they're going to have to come back into the U.S. markets. And frankly, after all the sell-off that we saw in software, as well as the hyperscalers and NVIDIA, they're looking cheaper. And so I'm expecting the U.S. markets to actually rebound and perhaps even outperform international markets.
Even if we have a prolonged war with Iran?
Especially if we have a prolonged war. And here's why. Iran is an oil producer. And right now, the Strait of Hormuz, I guess, is closed, right, officially. That actually has impact on oil prices and natural gas prices, more so for energy importers out there than the United States, because we are energy independent. Both on the crude oil side as well as liquefied natural gas. So the inflationary aspect is going to be more muted here in the United States in terms of price increases, even if it's prolonged, whereas that's going to have a much bigger impact on companies and citizens outside the United States, especially those countries that are depending on the Middle East for oil.
Then those countries, by the way, I read an article that pointed out, it was Rick Newman, actually, who used to be at Yahoo Finance, now on Substack at the Pinpoint Press. pointed out that the reason the straits are closed has nothing to do with Iran's ability to attack or keep them closed. It's actually the insurance companies have told the freighters to stop. And it would seem if the United States, as President Trump has said, has diminished Iran's capability to launch missiles and drones, that might actually open up in the near future.
Hopefully. Iran has also said that it would set any ships that are coming through the strait on fire, right? So I don't know exactly how they would do that, but that certainly is a threat that I don't think insurance companies would take lightly. So all of this is happening, it's changing by the minute. So it's sort of a wait and see thing.
So we're seeing huge bets on market stress from mid-March and June. Does the heavy hedging actually make the market more stable by providing a floor, or does it just set us up for an even bigger snapback later?
Yeah, traders are hedging because we haven't seen this kind of disruption in the global geopolitics from the U.S. in a very, very, very long time. But if you think about the VIX and how much it went up, it actually didn't go up as much as people thought it would, considering how much stress there might be in the markets and how much fear there may be. So I do think that there is some hedging, and it's my opinion that it will actually create more of a snapback. I think the markets, they didn't start selling off this week. I was already selling off starting this year, especially with the tech. And it's gotten to a point where it's cheap enough for people to come back. And when that happens and another momentum is created, that can be a very powerful turnaround. I'm not sure if the hedging activity would actually create a big rebound. I think it really is going to be the cash flow that comes in. Again, I think it's going to depend on the buy the dip buyers coming in. And that would be the large institutions that are seeing an opportunity to rebalance. And that rebalancing effect can be pretty powerful.
Are you buying the dip?
I am. I am buying the dip. Part of this is if clients have extra cash, whether it was because they wanted an opportunity to invest or, there was cash coming in as income from the fixed income and credit component of it. I like to take some of that cash instead of reinvesting it into the bonds. I like to take it and look for new opportunities. And certainly when the markets turn down like this, it has a tendency to go into equities to buy the dip.
Big article today that we posted on our website about Blackstone and redemptions from its private credit ETF or private credit fund. Are you worried about the threat of private credit? Jamie Dimon 2 weeks ago got everybody in a kerfuffle over it.
Jamie Dimon actually got us all worried. I mean, not me necessarily, but the market's worried with his cockroach comment last fall. Frankly, I think the private credit worry, and every day I see a headline about private credit, I think it's overblown. What's really important about investing in private credit, generally speaking, are two things. Number one, you have to choose the right manager. You have to choose the right partner. You have to be in the first lien. You can't be in the equity tranche. All of these things, and the due diligence and underwriting has to be robust. Those are very, very important factors in choosing who you partner with in terms of investing in private credit. And the second thing is you have to think of it as an illiquid instrument. Just because they offer quarterly liquidity, quarterly redemption up to a certain percentage, it doesn't mean that, you should see it as, I can take it out in a year. You really have to see it as a long-term instrument because the underlying positions are illiquid. I think if you change the perspective that way in both of those points, it could be a very, very successful position in your portfolio.
As someone who covered the great financial collapse, I remember when the two Bear Stearns funds went belly up the summer before the great financial collapse. All of that was supposed to have been done back then. And now we have private credit being offered to, Luddites like me through 401ks. Now, I wouldn't touch it with a 10-foot pole because I think it's opaque. But does the exposure to average Janes and Joes like me to private credit vehicles create a problem that could bring us to the headlines that some people are very worried about?
Yeah, you know what? The headlines actually can cause a lot of investors who are not as familiar and don't have visibility into those portfolios to withdraw en masse. And when that happens, you get situations like, Blackstone having to put out 7% or more a month, which is above their redemption limit, et cetera, et cetera. I think that the private credit world has rolled out these evergreen funds too quickly for the retail market. I don't think there's a problem with going into the retail market, but they didn't prepare us. I mean, people need to understand that these are not tradable bonds, right? I mean, you mentioned being opaque. They are opaque. So it takes a completely different view. And frankly, an advisor who really knows what's in them and how they work, and being able to educate the retail investors on what to expect from them. And whether or not they belong in a 401k, I think is a really good discussion to have as a society, because when people are choosing investments in a 401k lineup, they're not always getting the help to see just how much of their portfolio should be in these things and what they should expect. Sometimes they're just choosing, investment options from their desk online. So I think there has to be a bigger conversation about how the retail investors should be able to access these private credit funds.
When we're talking about due diligence and really reputable asset managers, I mean, Blackstone. We're not talking BlackRock, we're talking Blackstone. Is this redemption, rush that they're experiencing because they might have missed something in the assets they're holding, or is it because the clients are being propelled by panic headlines?
I believe it's actually been driven by clients. So there were two things that I think went against private credit. One was the cockroach comment, First Brands and Tricolor. These articles about these failures. And then, of course, there was the fact that, some positions were held at near par and the next day went bankrupt. These are isolated incidents, but when you see those things, you start to panic. Oh, I have my money invested in these things. I wonder if I should take it out. The second thing that went against private credit was the software sell-off. This idea that AI like Claude can actually replace these enterprise software companies overnight. And the fact that a lot of these private credit funds have exposure to software. And that actually also made investors very nervous and want to take money out all at the same time. So I think it is definitely a retail-driven redemption rather than investments going wrong in the portfolio.